Hi everybody, welcome to another update on the stock screener. I was browsing YouTube and I came across a comment about Monument Mining going up 30%. So I was taking a look and you can see that it's up 30%. So probably something good is happening. So I was interested and I have analyzed the company. I think it's a great buy here. So let's take a look at the presentation. So basically, this is a gold mine in Malaysia, and they are in construction of this plant, sulfide plant for gold, open pit, and I think they are commissioned. So the cash flow is going to come in right now. So yeah, Malaysia, they have the sulfide plant. This one has been closed because there's no oxide left, but now they are doing the sulfide. There are still some nuts and bolts to be constructed, but I think it's ready to produce gold. So resource base is almost 1 million ounces, so that's very good. That's a lot considering the market cap, which is only 40 million. They also have a lot of cash. So yeah, 40 million CAD. So that's about 20 million US dollars. And you have 1 million ounces. Just based on that, this is a steal. As I said, they have cash that's in US dollars and fully diluted and issued. Not too many warrants, so that's also good. Yeah, take a look at the management today of Malaysia, which is in production. And they also have a free carried interest in this Australia property. Not worth that much. I think it's worth 5 million or so. They only own 20% of it. So this is the flagship that we need to look at right now. So as I said, it's a flotation plant for sulfide. Grades around 1.5 to 2 grams per ton. This, not interested in that. But here, as you can see, they have a feasibility study. Cash costs 860. So AISC is probably going to be above 1,000, 1,100 with inflation in it. So we are going to use 1,100 AISC. And they can generate cash from this, 100 million over 6 years mine life. Could be that this can be extended with more drilling. Okay, so this interesting to know is they are using a phased approach to construct the plant. So they are now doing stage 1, which is only the flotation plant. So flotation plant is ready. First gold concentrate is right now being shipped in June, July. We are at 99% design capacity, so it is actually commissioned because 99% means that it's commissioned, right? So we're in full production now for phase 1. That's good. I like to buy things that are in production. 6 years of mine life, very fast payback of 2 years. Life of mine production 2 to 3,000. So divide by 6, it's about 35,000 per year. 35,000 per year at 1,000 AISC. That will give a lot of free cash flow. Capex is 53 million. I think they already used 20 million on that for phase 1. So there could be some other cash flow coming in, 25 million probably, to build phase 2 and 3. So let's see, these are the phases. Phase 1 is a flotation plant, cost 20 million. So probably they still need some capex, like 25 million for these things here. But this one is completed. Recoveries are at 80%. So keep that in mind, 80% recoveries. Then they can add a biox plant for the increasing of the recoveries, because 80% can be increased to 90%. So this is probably interesting to do, to increase the recoveries. 1 year of construction, and maybe later on they can convert it to oxide. But yeah, this one is more important. Okay, so let's just see what happens with this one first. How much cash flow will come in? Okay, so this is the flow sheet. This is the plant, all built. Probably these are the new cells that they bought. Warehouse. Take a look at the reserves. So we are only using the sulfide right now. And there is about 177 proven and probable, important. So that is proven and probable. So 177,000, you can do already 5 years on that. But they also have measured an indicator of 400 and inferred of 300. So add all of this together and you have 850,000 of gold. So probably the mine life should be 10 years if you take everything into account, and not 6 years. So interesting, mine life can probably be extended. And then there is also some transition material and oxide, not a lot. So most of it is sulfide now. But that's no problem because we have a plant to produce sulfide gold. Then they have the Australia property, just a property that has 380,000 ounces, could become 1 million ounces. Yeah, what is it worth? Maybe it could be worth $5 million. So not that important for this company. And that's it. So let's take a look at some of the numbers. So this was the latest financial report. Okay, so the all-in sustaining cost was $2,000 per ounce. Keep that in mind. Why is the AIC so high? In the March quarter. We will see why this is. Production is 2,400 in the quarter. As you can see here, 2,400. Look at the recovery rate, 42%. That's important to know. We are currently at 80%, not 40%. So we have double recovery rates. Ore processed, 89,000. We are currently not at 89,000. Probably it's double that right now. Because they were not at full capacity yet in March. I don't know if they have data on that. Where is it? Yeah, we don't have data on the capacity, but okay, take into account this number. And when you calculate the all-in cost, then we have 2,000, right? Let's see here. Total ore 82,000. Due to some problems. So lower than planned ore had some problems in Q1, but that's all being taken care of. There was some net loss, yeah, because they weren't at full capacity yet. And the CIL plant is on care and maintenance. So this is done, and we only use the flotation plant. The project has been completed with 20 million. And so they have used 11 million for the flotation plant and 7 million for development. Okay, and now they are in production. They started in January and it's now completed. So full production right now started in January and now completed. So now we look at the NPV analysis. First, take a look at this table. So what is the design capacity of this plant? It's 119 tons per hour. Times 24 hours times 30 days is 85,000 tons per month, right? That's the design capacity, and that's this number here, 85,000. So what was the tonnage in Q1? You can see it here. Ore processed 90,000 per quarter. So 90,000 divided by 3 is 30,000 per month. So you can see already here, the ore processed was 30,000 and now it's 80,000. So that's almost a triple in ore processed. That's the first thing to know. They are now processing much more ore. Second is the recovery. It was 40% in the first quarter, but now, latest news release, they say that the recoveries are in excess of 80%, on average 70%. So I used 70 and 80% here and calculated the ounces, and the ounces are recovery times the mill grade times the ore processed divided by 31 to get ounces. So currently we should have about 4,000 ounces per month. That's about 12,000 per quarter. So yeah, it's a bit lower than the feasibility study, but this is with BIOX. So we are currently at around 10,000 per month. I mean per quarter, and probably 4,000 per month. If you use a lower recovery, 70%, and if you use only 83% of the design capacity, because here they say on average it was 83% of capacity. So if you use 83% of capacity and 70% recovery, right, then you get 3,000 ounces. So it's between 3,000 and 4,000 per month. Let's say 3,500 per month times 12, that's 40,000 ounces per year. Let's be conservative and say 37,000 per year production. And this is actually confirmed by 2 to 3,000. Is 2 to 3,000 divided by 6 years, then you have 37,000 per year. So I think we can use 37,000 production per year on average, confirmed by these numbers here. And as you can see here, all-in cost is 2,000. I think this could fall to 1,000, yeah, maybe 1,100. 1,100 AISC is probably possible because the feasibility study said 860. So add some other costs to that. Corporate costs, sustaining. What other cost can there be? Exploration, sustaining, retirement obligation, accretion. Yeah, it's about at 300 to that. So we could be looking at 1,100 AIFC. So I used 1,100. Gold price. Capex, yeah, there's still a BIOX plan to be built, 25 million. Some drilling that they probably need to do. So added 5 million to that. Tax rate, they actually have tax breaks, but let's just add 35% taxes just for fun of it. And you get the 10% NPV here. Now, this is a very good project. You only have a 20 million enterprise value at the current share price. And look at this, they have excess cash. You can see that here on this balance sheet, 22 million in current assets, and the debt is 16 million. So they have more current assets than liabilities. So that's going to reduce the enterprise value, which is good. And look at the equity, 116 million US dollars in equity. This company is trading at 20 million right now and has 100 million equity. So it's very undervalued based on what it has, based on cash flows that are coming in. NPV at 74 million, 10% discount rate. So this should be actually already a double, triple. Yes. And that's also confirmed by the feasibility study. This is at 1,300 gold. We are currently at 2,000 gold. So somewhere here. And that should correspond with 90 million but let's say it's 70 million because they don't have the Biox plant yet. So it could be lower. But anyway, 70 million is very high compared to 20 million enterprise value. So if you just hold this for a few years, I think there is upside. Let's look a bit at the grades. Yeah, the grades were at 2 grams per ton, down a bit to 1.9 grams per ton. Not bad, that's a very high grade. Recoveries were 40% going to 80%, and it will probably go up more if they use the Biox plant. Production is going from 800 to 4,000. So this 800 here, that's coming from here. 2,400 production in first quarter. So 2,400 divided by 3 is 800. Now I use this formula, right? Let's see what happens if I do this. It's the same, 800, based on the recoveries, mill grade, and ore processed. So this is correct, this calculation. So they're producing probably right now at 37,000, maybe even more ounces per year. So the cash flow is coming in. That's very sure. There could be hiccups, of course, rain and etc., things breaking down, but if they deliver, then this is the future. Cash flows going to 60 million at the end of the mine life. What they do with that cash flow, I don't know. That depends on management. They have been acquiring bad assets in the past that they sold again for losses. But if they just give the dividends, buybacks to the shareholders, then this should be a very profitable endeavor. 6 years mine life can be extended probably. Let's take a look at this. So here we have some capex, around 40 million. 20 million is already used for the flotation plant. Everything is looking great. Yeah, the AISC we don't know yet. We should see where it will settle. So that could be a parameter that's unknown yet. But even, let's say, if it goes to 1,300, do we still have upside or not? Yeah, there's still upside. It could still go double even at 1,300 all-in costs, but it should be at around 1,100 based on this feasibility study. Cash cost 860. Yeah, should be around 1,100. Okay. Based on the EBITDA 5 times multiple, this should be an easy double triple. So this EBITDA is calculated from 1,000 AISC, maybe 1,100. Even then, there is plenty of upside based on EBITDA level. Production of 36,000. I think it could be 37,000. The grade, so the grade was 2 grams per ton, right? 2 grams per ton. But look at here, the sulfide is 2 grams per ton probable. Proven is 1.5, but most of it is 2. So the probable resource is at 2 grams per ton. Measured and indicated is a bit lower, 1.6. Inferred is 1.8. So all in all, I think we could see 1.8. 1.8, so this is a bit high. So let's say 1.8, 80% recovery. Yeah, there could be hiccups, 70%. Or processed 90, yeah, maybe it's 90% of design capacity. Then still we have 3,100 ounces per month, and times 12 gives us our 37,000. So going forward, I think we can have the 37,000 here on average. And this is the cash flow that will come in. So yeah, that was Monument Mining. I think the 30% increase is correct. This should go much higher. Could double to 0.3 to here at least. So yeah, very good suggestion from YouTube. And I'll see you next video. Bye.